Hello traders, welcome to my YouTube channel. The main topic today will be candlestick patterns. Candlestick patterns is a way of displaying information of an asset movement. They are most of the popular components of technical analysis, enabling traders to interpret price information quickly from just a few price bars. It focuses on a daily chart where each candlestick details a single day's trading. It has three basic features: the body, which represents the open and close range; the wick or shadow, which indicates the intraday high and low; the color, which reveals the discretion of the market movement. Green or white body indicates a price increase, while red or black body shows price decrease over time. Individual candlesticks form patterns that traders can use to recognize major support and resistance levels. The three great mini candlestick patterns that indicate an opportunity within a market. Some provide insight into the balance between buying and selling pressures, while others identify continuation patterns and decisions. Before you start trading, it's important to familiarize yourself with the basics of candlestick patterns and how they form so that you can make the decision to trade. Number one, let's look at the 6 bullish candlestick patterns that may form after market downtrend and signals a reverse of price movement, indicators for traders to consider opening a long position to profit from any upward trajectory. Hammer candlestick, formed of a short body with a long lower wick, and it's found at the support level of a downward trend. It shows that although there was selling pressures during the day, ultimately a strong buying pressure drove the price upward. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Inverted hammers or inverse hammers. The difference with the two hammers is that the upper wick is long while the lower wick is short. Indicates buying pressure followed by selling pressure that wasn't strong enough to drive the market price down. Bullish engulfing. It's formed over two candlesticks. The first one is short red body that is completely engulfed by a large green candle, though the second opens lower than the first bullish market, pushing the price upward. Piercing line, formed of a long red candle followed by a long green candle, and there is usually a significant gap between the first candlestick closing price and the green candlestick opening price, indicating a strong buying pressure as the price is pushed above the mid price of the previous day. Morning star, considered a sign of hope in a bleak downtrend. It's a three short-bodied candle between a long red and a long green candles. Three white soldiers. It occurs over 3 days. It consists of consecutive green or white candles with small wicks, which open and close progressively higher than the previous day. It signals a strong uptrend and it occurs after a downtrend. Bearish candlestick patterns. They usually form after an uptrend and signals a point of resistance. Heavy pessimism about the market price often causes traders to close their long positions and open a short position to take the advantage of the falling price. Hanging man, bearish equivalent of a hammer having the same shape but forms at the end of an uptrend. It indicates there was a significant sell-off during the day, but buyers were able to push the price up again. Large sell-off indicates that the bulls are losing control of the market. Shooting star. It has the same shape as the inverted hammer, but it is formed in an uptrend. It has a small body and long upper wick, Usually the market will gap slightly on opening and rally to an intraday high before closing at a price just above the open like a star falling to the ground. Bearish engulfing occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle, which signifies peak or slowdown of price movement, and it's a sign of an impending market downturn. Note this: the lower the second candle goes, the more significant the trend is likely to be. Evening star, formed of a candle sandwiched between a long green and large red candlestick, which indicates reversal of an uptrend, and it is particularly strong when the third candlestick erases the gains of the first candle. Three black crows comprises of three consecutive long red candles with short or non-existent wicks. Each session opens at a similar price to the previous day, but selling pressure pushes the price lower and lower with each closed. Traders interpret this pattern as the start of bearish downtrend. Dark cloud cover indicates a bearish reversal. Comprises of two candlesticks, a red candlestick which opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candles are short, suggest that the downtrend was extremely decisive for continuation candlestick pattern. Note this: if a candlestick pattern doesn't indicate a change in market direction, it is what is known as continuation pattern. These help traders to identify a period of rest in the market when there is market indecision or neutral price movements. Doji, formed when the market open and close are almost at the same price points. The candlestick resembles a cross or a plus sign. It conveys a struggle between buyers and sellers that results in no net gain for either side alone. It's a neutral signal, but it can be found in reversal patterns such as bullish morning star and bearish evening star. Spinning top has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. Bulls sends the prices higher and the bears pushes it lower again. They are often interpreted as a period of consolidation or rest. Following three methods used to predict the continuation of a current trend, be it bullish or bearish. The bearish pattern is called falling three methods, formed of a long red body followed by three small green bodies and another red body. The green candles are all contained within the range of the bearish bodies. It shows the traders that the bulls do not have enough strength to reverse the trend. Rising three methods. It comprises of three short red sandwiched within the range of two long green candlesticks. Shows the traders that despite some selling pressure, buyers are retaining control of the market. Traders, you have to practice reading candlesticks patterns. The best way to learn reading candlesticks is to practice entering and exiting trades from the signals they give. If you don't feel ready to trade on the live market, you can develop your skills in a risk-free environment by opening a demo or exam account when using any candlesticks. It is important to remember that although they're great for quickly predicting trends, they should be used alongside other forms of technical analysis to confirm overall market direction. To find out the best brokers and trading platforms to trade online, check on our video description. Thank you.